Thank you for checking out Real Talk Personal Finance. Shit's about to get real. Cash Flow King with you today. And in today's episode, we have the tax triangle, lifetime financial flexibility. Before we get into today's show, as always, we have several quick announcements. First, I would just like to say I hope that everybody had a happy and safe 4th of July weekend. I'm actually recording this on July 4th, but by the time it comes out, it'll be July 8th, and the July 4th weekend will be behind us. So I hope you had a great time with your friends, family, and so on. First thing I'd like to do is part of the shout-outs today is I want to read a new review that we got. This came in on June 25th from the Cash Flow Prince, and there's actually kind of a funny story that goes along with this, which we'll get into today. But the title of the review says, "High Informative." And it says, quote, "I listen to a lot of personal finance podcasts, and this one is a great new spin and approach. The host, CFK, Cash Flow King, and his guests talk in a real way and break down topics that make it for the listener to understand. Doesn't matter where you are in your finance journey, you will pick up good pieces of info if you're listening to this one." Thank you very much, Cash Flow Prince. He gave us 5 out of 5 stars. Really appreciate it. If you feel like we've earned it, feel free to leave the show a rating and review. As always, we appreciate that. It helps us to grow the show and reach more people. So that was the first announcement that I wanted to cover today. Next, we have a new premium subscriber. Very special shout out to Rebecca K, thank you very much for subscribing as a premium subscriber to the Real Talk Personal Finance podcast. You should have already received an welcome email with some additional information. Once again, we appreciate your support. If you would like to consider becoming a premium subscriber to the Real Talk Personal Finance podcast, it's only $3, people. You can find the link in your show notes description. If you click on it, there's a link, I believe it's all capital letters, that says become a premium subscriber today. And you can check that out and read about the different benefits of becoming premium. The next announcement here is we did receive some feedback regarding the show that we did on tipping culture in 2024. And so I wanted to, and I asked this individual if I could read this email, and I got his permission to do so. So I'm going to go ahead and share a portion of this email with you guys. But I thought it was really interesting, quite frankly, very surprising as well. And so the email came in, there's a few items here at the top, and then it goes on to say, "My tipping philosophy is rather similar to yours, where I just believe a tip is warranted when a service is provided versus expectation. For example, my good tipping story is I get my shoes polished at a shoe shine stand near my office weekly. Yes, I've been called bougie for doing this, but it's one of the few luxuries I indulge in. Anyways, the guy provides a service. The shine cost $5, and I give him a $20 because I appreciate the skill, time, and experience I receive. And yes, I do love sitting up there like a Rockefeller. Maybe that should be my name. Ha ha ha." And then he goes on with the bad tipping story. He said, "My bad tipping story is I was at my CPA's office a few months back, and we are going over the dreaded tax return. I typically owe the government money every year, and I whine and bitch the whole 15 minutes I am there because I don't want to pay them. Anyways, this year he must have gotten a new payment processing service, and he swipes my card on his iPad, and he hands me the iPad, and I see that dumb 15%, 18%, 20% screen. I look at him like, what the fuck is this? And I actually say, what the fuck is this? He said, if you feel the service provided is great, please choose your option, but I want to make sure to let you know completely not required if you don't want to. The listener said, I began to ask him if people actually tipped, and he said, yes, some do, but yet again, it is not a requirement. I told him I just wrote a check to the IRS for $12,000 and you want me to add another $100 to you for preparing my return. My answer is a big fuck no. Needless to say, I might be looking for a new CPA next year. And then there's another paragraph in the email that goes on to close it out and thanking us for the show and those sorts of things. But I wanted to read those two. And again, I got his permission before doing that on the show because, wow, I would be interested to see if anybody else has been presented or prompted with a tipping screen for professional services. Your attorney, your accountant, your financial advisor. Hell, maybe we should implement that. No, I'm kidding. We get paid, pretty well for what we do, and I think that's a little bit overkill. But anyway, that was a really interesting thing. That's the first I've ever heard of a CPA office asking clients to leave a tip for professional services. I know most of the time, like our CPA, for example, I think his hourly rate, it's changed a little bit, but I want to say it's somewhere north of $300 an hour. Like that's pretty good money, even for the skill that it takes to, prepare complex returns and things like that. And to ask for a tip on top of that, I kind of feel like is a little bit overkill personally. So I would have had the same reaction there, Cashflow Prince, or he signed off this email, Cashflow Rockefeller Prince. So this is the same person. He's a new premium subscriber who left us a review, and we've been corresponding quite a bit over email, and I appreciate that. I love interacting with you guys. So whether you're premium or not, if you have any questions, any feedback, any stories, anything that relates to the podcast or anything that we're doing, feel free to write the show, realtalkpersonalfinance@gmail.com, and you can also use the link in the show notes to send us a text message, and we will respond to you in audio format on an upcoming show. Last announcement is we have 2 new countries listening to the show. We have Spain and Jamaica. Haven't been there in a while. So Spain and Jamaica, thank you very much for tuning in to the Real Talk Personal Finance podcast. As always, we appreciate it. That'll do it for announcements today. I now would like to get into the meat of today's show, and we're going to talk about the tax triangle, lifetime financial flexibility. So let's start off with, first of all, there's no magic pill when we talk about any of this personal finance stuff, but I thought this might be a helpful episode to kind of run through because the tax triangles, sometimes we call it the tax diamonds, depending on who you're talking to, in the personal finance and financial services space, comes up a fair amount, but I don't think it comes up often enough. So I wanted to shine some light onto this here for a little bit today. So this tax triangle, first of all, what is the tax triangle? The way that we are going to talk about it in the context of today's show, I'm going to make several assumptions, and the big one I'm going to make is that this applies to people that are doing sort of quote-unquote traditional types of investments. So we're going to pretend that everybody on here is invested in the stock and bond markets. We're not going to talk about alternative investments. We're not going to talk about real estate investments or anything like that. I'm going to try to keep this fairly simple, and we're going to make the assumption that all of somebody's investments are essentially in the market, okay, in the public markets. So that's the first thing. When we talk about the tax triangle, literally picture a triangle, okay? I think everybody knows what a triangle is. And there's 3 points on that triangle. And for the purposes of today's show, we're going to define those 3 different areas or those 3 different points as pre-tax accounts, Roth accounts, and taxable accounts. Pre-tax, Roth, and taxable, okay? And you can put those labels anywhere you want on the triangle because it doesn't really matter which one's on the side, which one's at the top. As we know, if you spin the triangle, they're going to rotate, right? This is about creating financial flexibility for yourself throughout your lifetime. Quite frankly, this is something that I haven't always been the best at, right? I think a lot of people get this wrong, and I think that it's something that we can all continually work towards and work on in our financial lives, in our financial journeys. But this tax triangle, as we'll talk about, can be important for different phases of your life, of your financial life as you progress through. And it's going to affect everybody a little bit differently, okay? What we're talking about ultimately is having money in these 3 different areas or these 3 different types of accounts. And we're going to use these as categories because we really don't need to get all that granular to understand the overarching concept from today's podcast, right? It doesn't matter if when we say pre-tax, if it's a pre-tax 401k or traditional 401k, or if it is a rollover IRA, or if it's a 403b or whatever, it doesn't matter, okay? We're just talking about categorically types of accounts that exist and how those could interplay with each other throughout your lifetime. And by not paying attention to this, you could be doing yourself a disservice. And that's what I wanted to cover today. So I have a few different examples and then some comments at the end of the show. I have a little outline here on my phone that I'm going to go through. But the first thing I did is I wanted to just define what the tax triangle is for the context of today's show and why it's important. Now what I'd like to do is give some examples of what that might look like, okay? So again, this is about the importance of having some diversification as to where your money is because it's going to provide you the most amount of flexibility. So let's take for the first category or first example, you have somebody that is early to mid-career or early to middle age in their life, right? And they might have some larger early to midlife purchases that they want to make. Maybe that's the case, right? These could even be things you may not be aware of at this moment, but you would like to have a place to go to cover these things if needed. Now, I know people are going to say, hey, what about having some savings? And what about your emergency fund? What about ... And those are all good points and important things to have. But again, we're going to make the assumption that you have some savings and you have an emergency fund and that those things are truly for emergencies. So for example, when I'm talking about these early to midlife larger purchases, these aren't necessarily emergencies, although I guess one of them could be. So for example, I have a car on here. That could be an emergency if you had one vehicle and you needed to get to work and all of a sudden it blows up on you and you have to get a vehicle. Okay, fine. But some other things like home improvements or possibly taking a big trip or vacation or a honeymoon or whatever the case might be, right? Things that come up, you may have a general idea as to when they're going to happen, but you don't necessarily know for sure if they are even going to happen. And I can give you a couple of examples that we've run into, okay? But this highlights the importance, and I think this is really critical for younger people and even middle-aged people, really everybody, to have some money in a place that you can get to where you don't have to jump through fucking hoops and deal with, am I age 59 and a half? Does the rule of 55 apply? You know, do I need to do this, that, or the other thing? It's just an account that you can go to, that you can pull money from as needed, as desired, without any age restrictions, okay? And an example of this would be a taxable brokerage account, right? This is a non-retirement account that you can choose to invest in, and there's a million different brokerages out there that do this, and you can structure your portfolio however you want. That's beyond the scope of today's show. But you have access to the money in this account anytime that you want. Now, just like anything, there's going to be pros and cons, and that's why you should have a balance and have assets in multiple areas. But for example, we'll stick to this taxable brokerage account here for a couple minutes. So with this account, there are no contribution limits. In other words, you can put in whatever the fuck you want. If you have $200,000 that falls out of the sky and you want to drop it in there, go for it. If you have barely 2 pennies to rub together, but you want to start an account with $200 because that's all you got, go for it, right? Every company is going to have their own restrictions in terms of account minimums, but most of the time you can get started with a fairly modest and in some cases no minimum whatsoever. And there are different firms out there that do this. Some I like personally better than others as far as what you can do with the accounts and the management of the accounts and the flexibility of using them and setting up, partial purchases, and it gets a little bit complicated. Again, it's beyond the scope of today's show. If you really give a shit and you're lost as to, hey, I'm looking for a, taxable brokerage account, what do you think? I think our premium folks, I might have sent something out in the past about this, and no, it's not us. No, it's not with me. I don't want your money. I don't give a shit what you do, but it just some ideas and some different companies that could work for you in different scenarios. But anyway, this is something where you can put in whatever you want, as much as you want, typically as little as you want. You can take it out whenever you want. That is the major benefit in terms of the flexibility with this type of account. Now, what you need to realize on the flip side for the cons of this type of account typically is that you will have some usually minimal tax drag in some way, shape, or form. So for example, if you invest money into an account like this and you're in an investment that pays dividends, that's going to be taxable to you. If you put money into an account like this and you do the proverbial buy low, sell high, like everybody jokes about, and you put in a little bit of money over time, and all of a sudden markets do what they typically do, they go up, things are going well, and you sell that investment later for a gain, you may have to pay capital gains tax, right? This is not advice. These are facts. If you're confused or not sure, talk to your tax advisor. If you have one, talk to your financial advisor. If you're not sure, listen to the fucking show. Email the show if you want. I mean, we'll kind of help to walk you through the best we can without actually giving you advice. But that's how this is going to work. Now, for everybody, it's going to be different. And again, this is probably beyond the scope of today's show, but based on the rest of your financial situation, in some cases, this is going to be, in most cases, really, it's going to be negligible, right? You're not going to have to pay a ton of tax on any sort of capital gain or dividend income, especially if you're just getting started. If you've done this for a while, if you have some investments that have significant gains, things along those lines, yes, you do want to be very careful before you hit the sell button because you want to understand what the implications are for those decisions, right? It gets a little bit more complicated. The point is, there is a little bit of a tax drag. So it's not as tax advantaged per se as some of the other types of accounts that we'll talk about here categorically in a little bit. However, the taxes that you do have to pay are typically, not always, but typically going to be long-term capital gains rates. And generally speaking, those long-term capital gains rates are approximately half of what you might expect to pay for ordinary income tax rates, right? In other words, if you had $1 that you pulled out of a pre-tax account, like an old 401k plan that was pre-tax, that's going to be taxable at ordinary income to you. And depending on your tax situation, that can vary. If you pulled the same dollar out of this taxable brokerage account, this non-retirement brokerage account, and you had a gain that you had to pay tax on, generally speaking, if you've held it for longer than a year and a day, you're going to pay capital gains tax. For most people, that's 15%. Again, I don't want to get too far down the rabbit hole with this, but typically it's going to be less. Often cases could be approximately half of what you would pay if you were to take it out of another account where you were taxed at ordinary income. So once again, for this part of the triangle, this first point, this taxable non-retirement brokerage account, put in whatever you want, access it whenever you want. You may have to pay a little bit of taxes. If you crush it with your investment, be careful because you might have to pay a lot more. But generally, even though you have to pay taxes, it's not as bad as it sounds. And the major benefit to having an account like this, again, is the financial flexibility that that's going to provide for you, especially earlier on and even through, the middle stages, essentially pre-quote-unquote traditional retirement, right? Before you can generally access most types of retirement accounts, this is a great place to go for cash or money on top of what you might have put away in cash and on top of what you have locked away in retirement accounts. So I mentioned things like could be a car. And again, doesn't mean you need to pay cash for a car. That's a whole separate conversation. Should you, shouldn't you? We'll save that for another day. I'm just saying these are examples. Home improvements, right? Big trips, whatever the case might be. And I'll give you, as I mentioned a few minutes ago, 2 quick examples of how this happened for us, okay? We had been talking about doing a covered deck on our little back area there. We had, when I built the house forever ago, we had this, kind of a wooden, smaller deck, nothing fancy. It was fine for a while. Then it started to get degraded. It was slowly turning into a piece of shit. We stained it a couple times, and I'm like, eventually that's kind of a nice to do thing. We didn't really have a definitive plan, like we're definitely going to do this, but it was like, at some point we would probably like to put a cover deck on there. You hear people talk about different types of decks, and I was thinking about doing Trex, right? If anyone's familiar with Trex decking out there, right? And very durable. And anyway, it was all kind of up in the air. There was no definitive plan to do that. It was kind of a nice to do, nice to think about one day type of a thing, okay? Well, all of a sudden, we had some weather come through and we had some roof damage. And long story short on that is we actually were able to get a new roof. We filed an insurance claim and the insurance company covered a new roof. Well, what a great fucking time to build into that and just decide to go ahead and do the covered deck and do the Trex decking, and you might as well do it. What better time to do it than when you're putting a new roof on a house, which is essentially, mostly paid for in this particular case because of unfortunate circumstances or unfortunate weather events by the insurance company. So we decided to do it. We had to make some decisions quickly. And it was like, all right, well, we got to go somewhere for the money. And there's different ways to pay for it. But it was nice to be able to click a couple buttons in a brokerage account, sell some investments for nominal, if any, taxes, and just have the money there ready to go and pay for it, right? And that's basically what we did. So that's one example of something that could come up. We got a nice Trex deck now. It's a nice little covered deck on the back. Nothing overly fancy, but it's bigger than the one we had before. We got a little gate on there for the dogs. It's awesome. We love it. My wife loves it more than I do. I do like it a lot. But anyway, it was nice to be able to have a place to go for that. So that's one example. Another quick example, if you've listened to the shows recently, you know that we just picked up another turnkey rental property. That was something that was interesting the way that happened. If you haven't checked out that show, go back and listen to it. But this is something that we knew we wanted to do. We just weren't finding the deals that we wanted. The numbers weren't penciling the way we wanted them to. And we were kind of sort of on the sidelines. We knew it was going to happen at some point, but we kind of took it off the main part of the radar and just said, if something comes through, fine, but I don't think it's going to happen anytime soon. Well, what happened? If you listen to the show, lo and behold, we're on vacation. It comes through. We saw something we wanted. Boom, we had to lock it up and move pretty quickly. Once again, it's nice to have a place to go, and a portion of that in terms of down payment and closing costs and things like that came from selling some investments in the brokerage account, okay? And I understand that everyone's situation is going to be different. You may never have these things come up. You may have more than the number of these things come up. But the point is, we didn't have to say, hey, we need to dip into a retirement account early, or hey, we need to go out and get this crazy high interest rate loan in order to do this. Like, the money was able to be accessed because it resided in that portion of the tax triangle. It was in the taxable brokerage part of the triangle. And there was a couple of a little bit of cash that came from some of the savings accounts and stuff like that, but there was also a sizable amount that came from the brokerage accounts for these purchases. So my point being, as I mentioned at the beginning of the show, I haven't always been the best about this, quite frankly. This is something that generally initially I didn't do any of this. Everything, if you listen to my show several interviews ago on the Unveiled podcast, virtually everything was going into retirement accounts at the time. And then over time, I decided to slowly start to build out this part of the triangle, but it happened a lot of cases where once that was built up, it very quickly went into other types of non-liquid investments or semi-liquid investments like real estate, for example, and that's a whole separate show. The point is, I haven't always kept a robust balance there, so I felt like I was in this cycle of constantly building it up, only to invest it into something else, and building it up, and then invest it into something else. But no matter what your investment strategy or style is, it's nice to have accounts like this to have access to for whatever might surface in your life. That's my point. So that's the first part of the tax triangle, is that taxable or that non-retirement taxable brokerage account that I mentioned at the first part of this show. So that's something to consider having depending on what you think you may spend money on. And the other thing that kind of segues into the second section here I want to get into is if you're considering having an early or earlier retirement, or just having some transition flexibility, even if you're not going to make a big purchase on something, it's nice to have money in an account like this for other purposes as well. And that's going to be a great segue into this next section, which is early or earlier retirement / transition flexibility. And so if you have money in this part of the triangle, right, these taxable investments, you have the ability to do some things that other people may not be able to do. Maybe you wanted to retire early, and yes, there's other strategies, and we'll touch on a couple of them briefly here shortly, to get money from your retirement accounts younger than your traditional quote-unquote normal retirement timeframe ages. However, you also have the ability to do some transition things that other people might not be able to do. So for example, if you get let go from your job, okay, maybe you collect unemployment, maybe you got some savings and you get an emergency fund or whatever, but maybe, you decide you want to be able to be picky, or you have the luxury or the choice of being able to be picky and not take the first job that comes along because you have some money in an account like that that's able to help sustain and float you during that time frame. Or maybe you're just a handful of years from those traditional retirement ages. You decide you have more than enough. You don't want to work anymore. And instead of doing anything over the top in terms of, retirement account strategies and distribution strategies, you just say, you know what, fuck it. I'm going to pull a little bit of money out of this account for the next handful of years until I hit, for example, 59 and a half, and then I can start to tap into some of those other accounts. This taxable, this non-retirement brokerage account could also function for you in that way. So that's something else that's kind of nice. And I had a conversation briefly with somebody recently that I won't go into too much detail, but this is an example of how this potentially could have helped that individual had they had this in place. They are going through some stuff in their professional life right now where there's a possibility that there could be a job loss and the person makes a significant income from this particular job. Well, if there is a job loss, yes, there might be some other places to go, but they are starting to contemplate now the fact that they may need to sell a home, which they have substantial equity in order to bridge that gap between that job loss and then the next job, right? And this is somebody who, and again, everybody has opinions on this, and doesn't mean that my way is the right way, but just something to think about where, a lot of people are so dead set on paying off a mortgage, and they're paying extra principal, and they're essentially locking their money up, right? And there's a difference between paying down a mortgage aggressively and getting it paid off early versus writing a check or clicking a button and boom, all of a sudden it's gone. Either way, that money is not easily coming back to you. But this person was paying down their mortgage aggressively. They weren't necessarily doing anything with like these taxable brokerage types of accounts. And so now the money's locked up in the house. They have substantial equity in the house. But as I mentioned, this job situation comes along, and if things go south, they are looking at the possibility of needing to sell that home in order to tap into the equity in that home. And it's not exactly a fun situation, right? And not a situation this person wants to be in. And, my heart goes out to them, but it's something where I don't want to say it could have been avoided because, if you're going to get let go or things are going to happen in the business world, they're going to happen. But my point is, instead of putting those extra dollars and locking them up into a house in the form of home equity, those dollars could have gone into a taxable brokerage or investment account and could have been liquid and available for, as I just mentioned, this transition flexibility, this transition period, which I don't think a lot of people are thinking about, right? So that's just an example. Two other things I wanted to mention under this category of early or earlier retirement / transition flexibility are, first one is now I'm going to go to a different point on this tax triangle. So far, we've talked exclusively about the taxable brokerage account, which is 1 point out of the 3 points on the triangle. Let's go now to one that, a lot of people are somewhat familiar with, the Roth portion, okay? And I know we said we weren't going to get account specific, and I'm going to try not to go too far down the rabbit hole on this one, but let's just pretend we're talking about a Roth IRA in this case. All right, if you don't know what that is, we got plenty of episodes on them. If your income is high, you can check out the episodes on the backdoor and advanced strategies, and I think we have one called Roth IRA Intermediate Concepts. Go back in the archives, you'll find them. But let's just assume that this person is able to make a direct Roth IRA contribution. Well, if they're in this same transition period or they're looking at earlier retirement, again, not a recommendation to do this, just an idea, just a possibility, they technically have access to all of their Roth IRA contributions, not the earnings, not the growth, just their contributions, the money that they've directly put in, anytime, any age, any reason, no tax, no penalty. Those are just the rules, right? So that is another point on this triangle. I think most of us in the financial services space and the personal finance space would lean towards using, in most situations, again, there's always going to be an outlier, but you probably would end up leaning toward using money from a taxable brokerage account before you used your Roth IRA contributions, but it's still a possibility. And the fact that you have a Roth IRA and you've made contributions to that Roth IRA, it's not exactly ideal in most situations, but that's one additional place that you have to go if you need to during a time period like this, because it's another point on the triangle, right? So that would be an example of having money in the Roth area of the triangles, in this case, specifically a Roth IRA of the triangle. The third point, which most people, and we'll get into this in the next section, where they have the vast majority, if not all of their money, is on the pre-tax portion of this triangle, right? And for somebody that has money in the pre-tax portion of the triangle, well, in the context of this early or earlier retirement / transition flexibility segment, they could do some strategic partial Roth conversions, right? So there's a benefit, I guess you could say, of also having money in the pre-tax portion of your portfolio, because depending on how your plan is and, how your financial life unfolds and where your income sits and the different ages where that might happen, you have the ability to do some strategic partial Roth conversions. And typically after the 5-year conversion clock, you would begin to start to have access to some of those funds. I'm not going to get into too much detail on that. It's probably more of an advanced concept. It's really beyond the scope of today's show. But my point in these 3 examples for this segment is that by having money in these different areas of the tax triangle, you have options in terms of earlier retirement / transition flexibility into different extents for each one, but it's because you have your money spread in different areas. You have a choice, and you need to be able to navigate that, sometimes with the help of a professional, sometimes on your own. Most people listening to this are probably do-it-yourselfers, so you're probably fairly well-versed in this, and if you're not, awesome, because you're hopefully learning something listening to the show. But these are things to be thinking about and tools to have in your arsenal so that you can use them as needed, when needed. The third and final category that I want to talk about before I get into some closing comments and tracking stuff on today's show is, and this is what I see in the industry as a financial advisor and certified financial planner, a lot of clients, especially if they come to us from elsewhere, and in some cases those that have worked with us for a while, but we try to educate them on these things so that this doesn't happen. But one of the biggest mistakes I should say that I see for pre-retirees is they have all their fucking money in pre-tax accounts. It's all in the pre-tax tip or portion of the triangle. They don't have barely anything in Roth, and they have barely, if anything, in the taxable brokerage account area. Okay? And there's a lot of different implications for doing this. I will start by saying that a lot of these clients, historically speaking, in their defense, they didn't necessarily have access to Roth in a lot of cases, specifically through employer plans. But even with Roth IRAs, yes, they've been around for a couple of decades plus now, but it's still a fairly new or newer concept and area for a lot of people. Maybe they didn't really know about it. Maybe they didn't have access to it, and it was always pre-tax. And historically, that's how a lot of these plans, these employer-sponsored plans, are set up anyway, even to this day. Many of them have Roth components, right? And that's great, but a lot of them either don't, or they have their default if you don't do anything. And a lot of these plans now are using auto enrollment, where you're automatically enrolled at a new job. They are defaulting people into pre-tax contributions, right? So even if you didn't do anything and you thought, well, shit, money's coming out of my paycheck. I went to work for this new employer and I'm putting money in my retirement, and you don't give it a second thought because it's happening automatically, right? Well, guess what? They're building up the pre-tax bucket for you, which isn't a bad thing, right? As we'll talk about, but it's just something to be aware of, especially if that's where all your other money is. So why do I say that this is one of the bigger mistakes that a lot of pre-retirees make? And there's a few reasons for that. One of them, you have limited control of your income, right? So as I mentioned earlier in the show, if you were to take money out of a pre-tax account, let's say it was a traditional pre-tax 401k plan from, let's say it was an old job, that's going to be taxable to you at ordinary income rates, right? Well, that's fine, because generally speaking, you can choose when to take it out or not, how much to take out or not. And a lot of that is largely going to be a function of what your needs are in retirement, assuming you don't have many other sources to tap into. I mean, you'll have some, which we'll talk about, but you're going to be taking money out as you need it pretty much, right? So that's fine. Eventually, though, with most of these types of accounts, specifically pre-tax accounts, you will have to start taking money out of these accounts. And this is where people really get into trouble. It's called required minimum distributions, or RMDs. And I won't go too far down the rabbit hole because, again, it's beyond the scope of today's show to get too granular. But it is important to touch on the concept because it is something that most, if not virtually all of us, in some way, shape, or form will likely have to deal with. And that's when the IRS pretty much says, hey, you've had these tax-advantaged, pre-tax retirement accounts now for a period of time. We want you to start taking money out because we want some fucking tax money, right? And the ages for that have changed over time, right? Back in the day, it was 70 and a half. Then it went to 72. Then it went to 73. Pretty soon it's going to be at 75 based on the Secure Act and Secure Act 2.0 and all that shit. The point is, you will have to start taking money out of these accounts whether you need it or not, whether you like it or not. And that money is going to be fully taxable at ordinary income rates, which can have an effect on the rest of your retirement income situation, right? For example, let's say somebody has a pension. Every state's different in terms of how they handle that, but generally speaking, that pension income is going to be taxable. Well, guess what? This pension income and now the retirement account distributions, whether by necessity or if they waited long enough until they're taking RMDs, these required minimum distributions, that all is taxable. And guess what? That is rolled up into what used to be called the provisional income formula. Now it's technically called the combined income formula, which determines how much, if any, of your Social Security retirement benefits are taxable. And there's 3 tiers, and we're not going to get into all that today, but the point is, all of this counts in the formula. Even half of the Social Security benefit that you're receiving counts in the formula. And so by having all of your money on the pre-tax tip or point of the tax triangle, you are giving yourself fewer and fewer choices in terms of navigating what that looks like in retirement. And what you could accidentally do is permanently traject yourself into a much higher tax bracket. And who knows exactly what tax rates are going to do. Most people think they're going up. That's a separate story. But the point is, you may put yourself in a situation where you can't get out of it, right? Your pension, and it's a good thing to have for those that have pensions. A lot of people won't. But that alone could make it so that, hey, up to 85% of your Social Security retirement benefit is going to be taxable because there's nothing you can do. Well, what if you don't have a pension? What if you're going to live on some retirement account distributions? And now, depending on how much you're taking out and what type of accounts you're taking them from. Is it a pre-tax retirement account on that one tip? Is it a qualified distribution from a Roth retirement account on another tip? Depending on where that money comes from, that income, those distributions may or may not be in this formula, and therefore it may or may not tick your Social Security retirement benefits upwards to the point where a larger percentage of those benefits become taxable. So for example, if you, instead of having all the money forced out of, and when I say all the money, it's not all coming out, right? Generally speaking, these RMDs are fairly nominal. They're starting just south of 4%. Back in the day, it used to be just north of 4%, depending on when you're starting them. So for the ease of just keeping it simple, we'll say ballpark figure, those RMDs are going to start at approximately 4% of the prior year's value at the age that you have to start taking it out, and that will gradually change over time. The percentage will gradually go up over time. Well, on the pre-tax account, you have to take that out. That money's going to count. If instead those funds were in the Roth portion of the triangle and you took it out of the Roth account instead, none of those qualified distributions count in that formula. So theoretically, you could take an unlimited, let's say you had no pension, right? Theoretically, you could take an unlimited amount of income as a qualified distribution, meaning that you've had the Roth account open for at least 5 tax years and you're at least age 59 and a half. If both of those are true, it's a qualified distribution. Any money that comes out of the Roth account, completely tax-free, does not count in terms of making any portion of your Social Security benefits, a larger percentage of that becoming taxable. And you could put $1 million a year out of a Roth account and get your Social Security retirement benefit, have no other income, and pay 0 taxes under current law on your Social Security retirement benefit. Now, is that realistic for most people? No. Most people are probably going to have some money in pre-tax. They're going to have RMDs. They might have pensions. That's fine. The point is, though, instead of putting all your money in pre-tax and not being given a choice, wouldn't it be nice to have money in different areas, including on the Roth side, so that you can navigate those distributions as they're coming out, how much you're taking from different areas, and not accidentally but permanently put yourself in a higher bracket and thereby cause yourself to pay more taxes on something like your Social Security retirement benefits needlessly if you didn't have to do that in the first place. So these are all things to be aware of. Do you need to be an expert in these areas? No. That's why people like me exist, right? And no, this is not a pitch. I don't want your business. I don't want your money. I do not contact the show for that reason. We are not that is not what this is about at all. But the point is that this, in my opinion anyway, kind of a side note here, financial advisors that focus on and specialize in retirement income planning can help you navigate these waters a little bit, right? So do you have to be an expert? No. The takeaway from the show and the thing to know and be cognizant of is having money in different areas on the 3 different points of the tax triangle is only going to help you when it comes time to navigate this, ideally with the help of a professional, so that you don't get caught in some of these tax traps that a lot of people get caught in. Because if all your money's in one area, you don't really have a lot of flexibility when it comes to retirement income and distribution strategy. So that's just something to know, okay? Now, that was the third category I wanted to talk about on today's show. I want to wrap up with a couple of other items here. The first one is track it. sometimes these things are going to get out of balance. Like I personally track this, and I'll admit I've not been the greatest about doing this. I have a bunch of different spreadsheets, and then when I got married, we integrated some stuff, and we have like this little, it's essentially a Google Sheet document, but it feeds into this kind of manually created financial dashboard, and we have different types of investments. So it's somewhat complicated. But anyway, there was a section on one of my spreadsheets historically, and I just finally put it on the new one that tracks percentage in these different areas, essentially tracking this tax triangle, because I want to know at first glance, what does this look like? Now, I mentioned at the beginning of the show, we are making the assumption that when you're doing this, you're only investing in things like stock market type of investments. Now, that might not be true of everybody. It's not true of us. As you guys know, we invest in real estate. So I had to modify this a little bit, and I have a section where I do, what's fully liquid versus what's semi-liquid, and then I have the totals. And I look at this in a couple of different ways in terms of what the breakdown looks like. The point is you can easily track this on your own, and even if you just had, a few different cells on a spreadsheet, here's how much money I have in pre-tax investments, right? Here's how much money is in Roth. Here's how much money is in taxable. Here's my total, and here's the percentage in each. And you're probably wondering, well, what's the magical percentage, Cash Flow King? And the answer is there isn't one. Okay, at least in my opinion, there isn't one. There's different opinions out there. I just like to see and know that it's not overly concentrated in any one area. And I will tell you, as I just mentioned, that this does get out of whack from time to time. In fact, right now for us, because of some of these larger purchases, with the deck and then with the rental property and some other things, it's a little bit out of whack. We are working on rebuilding the taxable side of the equation at the moment. Okay, so it's not ideally what I would like it to be, but the good news is that it was there for the time and things that it was needed for, and you can easily shift your strategy in terms of future cash flows and dollars and where those dollars are going to rebuild different areas of this as needed. Okay, so when I look at it and I do it on the spreadsheet, not that anyone gives a shit, but just in case you do, I'm going to read off some numbers because I prepped them here before the show. We, as I mentioned, have a fully liquid, semi-liquid, and then like a total as far as that goes. So if I include semi-liquid, which is going to include some real estate investments like the turnkeys, right? I can't click a button and sell a house, but I can put it on the market, and probably after a couple of months, 2-3 months, whatever the case might be, we could sell it if we needed to. So to me, it's not liquid. A Cube Crusher would probably say, well, it's fucking illiquid. It's pieces of shit real estate. Love you, Cube. But I would say that it's semi-liquid. It's going to take some time. It's not going to happen right away, but I would consider it semi-liquid, but I certainly wouldn't consider it fully liquid. So when I look at this and we include the semi-liquid investments, ballpark breakdown percentage-wise at this moment in time is about 37% taxable investments, which includes the real estate in our case, 45% pre-tax, and 18% Roth. Okay, that's including everything there. Now, if I just strip that out, if I strip out the real estate and the semi-liquid and I just go for the fully liquid investments, and when I say fully liquid, just keep in mind, again, I'm talking in this case basically just about stock market types of investments. Just because it's fully liquid doesn't mean that you can access it without taxes and penalty. But if I really, really wanted to, I could click some buttons, and I might have to eat some penalties, and I might have to pay some taxes, but generally speaking, I can get at the money, right? That's what I mean when I say fully liquid. If we did the breakdown just under fully liquid, it's somewhat embarrassing to say that right now, just under 1% of it is in the taxable category, 76% is pre-tax, and 24% is Roth. So I bet you can guess, as I've already stated, but I bet you can guess after that little breakdown where the focus is right now, right? This is constantly going to morph. It's constantly going to shift, and you have to make adjustments, whether it's because, like in our situation, where some money was taken out to buy and invest and do some different things on the taxable side. Okay, you might need to adjust your taxable. Well, maybe you have an awesome employer match at your workplace retirement plan, and maybe you're also putting in pre-tax money into the plan, right? And maybe you're not maxing out a Roth IRA, for example. So you might, but you're putting a little bit of money in it. Well, you might notice that all of a sudden your pre-tax shoots through the roof. Why? Because up until prior to 2024, and most plans haven't adopted this yet, so virtually, reasonably, all plans, with a few exceptions, of course, the employer match is pre-tax. So if you're putting in pre-tax and the employer match or employer contribution is also pre-tax, that's building up your pre-tax bucket pretty fucking quick, right? So that's something to keep in mind. Another reason that you want to kind of monitor this stuff, right? I'm not saying don't put in pre-tax. I'm not saying anything, right? Because we don't give advice on the show, as you guys know. But what I am saying is you need to keep that in mind as you're building this out and as these amounts will change. That's why you need to periodically track your percentages. It's not something you need to update every day, but even if you took a look at it once every 6 months, once every year, hell, once even every couple of years, if you really wanted to be lazy about it, you could, and you'd probably be just fine. What you don't want to do is turn a blind eye to it for 15 or 20 years and then wake up one day getting closer and closer to retirement and say, fuck, all my money's in pre-tax. I have nothing anywhere else, and now I have no flexibility. That's what you don't want, right? Okay. So last couple things here, as I said before, there is no magic breakdown, but just for the purposes of the show, this is kind of a one-to-many, medium here, right? I am podcasting. I'm sitting here in my, little dining room area recording this for you guys, and I don't know everybody's situation, right? We don't give advice on the show, but I had to come up with some general guidelines and things that you guys might want to think about that I thought would be helpful. So I have 3, okay? We'll start with the first one. If money is tight for you, right, and you're trying to build out your tax triangle from a tax diversification standpoint, this is something you might consider. If money is tight, maybe you do pre-tax contributions to your retirement plan at work up to the point of the match if you get one. That will have the least amount of impact on your take-home pay. It will ensure that you're capturing the full match from the employer if your employer has one. So you would do a pre-tax retirement plan, like let's say it's a 401k, for example, pre-tax 401k contribution up to the point of the match. So if they give you a dollar for dollar match up to 6%, you'd be putting in 6%. If they give you 50 cents on the dollar up to 4%, you'd be putting in 4%, for example. Okay? So if money's tight, pre-tax up to the match, and then if you can't afford to max out a Roth IRA, currently $7,000 a year, maybe you split the money you're putting away on top of that between Roth and brokerage. So you might be putting 4 to 6%, for example, to get the full match pre-tax into your employer plan. And I'm just making up numbers. Let's say you had $100 that you could then invest on top of that. Maybe $50 goes into your Roth and $50 goes into your brokerage account, whatever the numbers might be. That's an idea for somebody where money's pretty tight. Okay? That's number 1. Number 2, if money would be, let's say, semi-tight for you, we would start in the same way where we would do the pre-tax up to the point of the match. But then instead of immediately splitting between Roth and brokerage, if you have a little bit more money to work with, maybe you go ahead and max your Roth IRA at the $7,000 and then put some money into the brokerage account after that, as long as there's a reasonable amount of money that can still flow into the brokerage account. So that's an idea for somebody that is semi-tight in terms of money. Number 3, money's fine. No big deal. Okay, if that's what you're looking to do, then maybe, and then again, this isn't for everybody, depends on your situation, but maybe you max your employer-sponsored plan at work. So you max contribute to your retirement plan at work pre-tax. So that's $23,000 if you're under age 50, right? You can do an extra $7,500 in the year that you turn age 50, so that'd be $30,500. So you would max out your 401k plan, let's say at work, pre-tax. Then you would max your Roth IRA, $7,000 again if you're under age 50, $8,000 if you're 50 plus, and then anything after that could flow into the brokerage account, for example. That would be if money's fine. I would say probably more than fine. If you're able to put that much money away, money's probably more than fine. You're doing really well, and congratulations if that's you. But in that category, that would be an example of something that you might consider. Again, it's not going to be for everyone. You'll notice that on all 3 scenarios, I mentioned pre-tax contributions to a retirement plan at work. That is not going to be the right answer for everybody, right? It's very individualized, especially if you're in a 10 or 12% federal bracket. Again, not advice, just some guidelines here. You might want to consider, if you can, putting money into the Roth portion of your retirement plan at work. If they have a Roth 401k, for example, you would probably want to consider doing that as opposed to pre-tax. Again, everyone's situation is different. This is just a general blanket statement here, okay? Last thing I'll say on this episode about the tax triangle stuff is, personally, in my opinion on this and my actions on this, have changed over time. If you want some additional thoughts, we did an episode, I think it was me, Cold Brew, and Cube Crusher. We did an episode on pre-tax versus Roth. We might revisit that at some point, but I thought that was a really good one. We had some good feedback on that episode, so go back and check that out on pre-tax versus Roth contributions featuring Cube Crusher and Cold Brew. We had them on. But in general, what I am doing now and what I like to do is pre-tax retirement plan at work, so pre-tax 401k. Love the Roth IRA. So that's kind of table stakes there, maxing Roth IRA or back to a Roth IRA if your income's over the thresholds. If you're not sure, check out those other episodes on Roth IRAs. And then do that in combination with a brokerage account. Put some money into a brokerage account as well. So basically, you never want to miss your employer match. You always want to be pumping money into Roth, whether it's direct contributions or backdoor Roth contributions. But the main thing and the main takeaway, and again, I've been guilty of this myself, and that's one thing that we're kind of working on now, is getting your non-qualified or your non-retirement, your brokerage assets up. So don't forget, if you take nothing else away from the episode today, don't have all your money in pre-tax, get some Roth shit going, and don't forget about the taxable brokerage account because it will save your ass. If, shit hits the fan, the last thing you want to have to do is pay taxes and penalties on an old retirement plan because you didn't fucking put any money anywhere else, right? Yes, there's emergency funds and there are cash accounts, like I said at the beginning of the show. That's great. But don't forget to put some money in the brokerage account. That is one of the biggest things and biggest oversights I think that a lot of people make, myself included historically, is that there was either no brokerage account or there wasn't enough money going into the brokerage account. It will and can save your ass. So with that said, I hope you guys enjoyed today's episode. Shout out on the tax triangle, lifetime financial flexibility. Shout out again to our 5-star review that we got and our new premium subscriber, Rebecca K. Thank you very much. The tipping culture feedback from the cash flow Rockefeller Prince. Really appreciate that. And shout out to our 2 newest countries, Spain and Jamaica. Thank you everybody for listening to the show. Don't forget to leave us a 5-star review, share the show, consider becoming premium, pick up some merch. We got some awesome promo codes. And until next time, we will see you in the next episode.
Check the mic and make sure it sound right, boys.